Hi, I'm Steve Bigger, Director of Equity Research for S&P Capital IQ. Welcome to this week's edition of Equity Analyst Forum. With me today on Equity Analyst Forum is Telecom Services Analyst Rob DeZago. Rob, welcome to the program.
Great to be here.
So this week's focus stock of the week is Equinix. Can you tell us a bit about the company and the history?
Yeah, sure. The company was founded in '98. They went public in 2000. They're the largest global provider of network neutral data center services. What they provide is they provide a mission critical service for the major providers of telecom services, cloud, internet, digital media, content, financial services. You know, these customers rent space within the Equinix facilities to really create a seamless service that you and I use on a daily basis, and they do it in a best-of-class facility.
So how would you say they differentiate themselves in the market?
Sure. I mean, anyone can take a building, gut it out, put in some power, and put in some air conditioning and call it a data center. And there is a need for that kind of data center in this market. But Equinix has a tremendous first mover advantage in what they do. What they built is they built an ecosystem of customers. They have over 900 different network providers, which is like telecom services providers, and they have over 4,400 customers all located within these data centers. They come to Equinix because they want to exchange traffic with each other. So their customers are coming to them, and then their customers exchange traffic with each other. So it really creates like a magnetic ecosystem that attracts new customers and keeps them there. And it's very hard to replicate. You know, companies have tried, but to produce a global infrastructure like Equinix's cost you billions of dollars, spend multiple years to do it, and then at the end of the day, you have no customers to start with. You'd be starting from scratch. We just haven't seen it done before.
How about valuation? So how are you valuing this company, and what kind of upside do you see?
Sure. These data centers, once they get full, produce a lot of cash and a lot of cash flow. So we use a discounted cash flow valuation to value this company. We put a $220 valuation on a 12-month price target, which is about 35% upside from today. We also value it on a multiples basis using EBITDA, which I think is a pretty fair metric in this industry. And we put a 14 times EBITDA valuation for a company that's growing mid-teens over the next 3 years.
Now, how about the catalyst? So why is it a good time to buy it now?
Sure. On a baseline, we love the stock because they have a huge competitive advantage over their peers and some very high barriers to entry. They've got very good visibility into the revenue stream, a highly recurring revenue base. And they have a history of beating expectations. You know, so right now they're positioned in the middle of a very favorable technology trends. Growing internet traffic, rising uses of cloud computing, and everything going mobile. Couple that with a growing financial services business and a growing enterprise business. They've got a nice diversified revenue stream that we think has some upside. Further, they're planning on becoming a REIT in January of 2015, which we think can also add some upside to the name.
How about risks? What would you highlight there?
Sure. You know, the two key risks, churn is the first key risk. You know, customers are always rationalizing their network gear, and they're always pulling equipment out here and pushing equipment here. So sometimes you'll get a customer that'll pull some gear out of the facility, but they tend to replace it pretty quickly. They've been running at 75 to 80% utilization inside their facilities historically, so we think it's a pretty low risk. And the second risk is if they don't become a REIT. The company has spent a lot of capital and a lot of time and effort for this 2015 REIT conversion plan. And I think a lot of that is being baked into the stock at this point as well. So I think a failure to become a REIT could be a risk for the company as well.
Great. Thanks, Rob. And that's been this week's edition of Equity Analyst Forum. We'll see you again next week.